Advanced wealth building transcends traditional income or asset accumulation. It focuses on strategic positioning within economic systems. This approach involves designing one's financial landscape deliberately. The goal is to optimize influence and control, not just wealth accumulation. It's about structuring finances to exert greater power and direction. This strategy shifts the paradigm from passive growth to active systemic engagement. Capital mastery involves a profound understanding of economic cycles and market dynamics. This understanding enables investors to make proactive and strategic investment decisions. Capital is allocated strategically, often before market trends become widely recognized. This approach allows for the capitalization of early opportunities in emerging markets or assets. Such mastery leads to superior returns by anticipating shifts rather than reacting to them. Capital mastery involves strategic financial management, particularly regarding liquidity. A key aspect is holding liquidity during periods of widespread market euphoria. This means retaining cash reserves when others are aggressively investing. Such strategic retention positions an investor for future opportunities. It enables effective capital deployment when market conditions shift. This strategy is crucial during panic or market downturns, allowing advantageous investment. Capital mastery emphasizes strategic deployment of financial resources. The primary advantage in capital mastery is not the speed of action. Instead, it relies on disciplined timing for optimal outcomes. Successful capital deployment requires precise, calculated interventions. It avoids impulsive reactions to volatile market fluctuations. This approach ensures more effective and sustainable financial growth. Every economy operates in predictable waves, known as the economic cycle. This cycle consists of distinct phases that economies move through sequentially. The initial phase is expansion, characterized by growth and increased economic activity. This is followed by excess, then a period of correction, and finally a reset. Understanding this cyclical nature is fundamental for anticipating market shifts and trends. Economic cycles represent the natural fluctuations of growth and contraction in an economy. Amateur participants often react to these cycles as they are already unfolding. This reactive approach means they respond to current market conditions. In contrast, professionals adopt a proactive stance towards economic cycles. They actively anticipate future market conditions and trends. This foresight allows professionals to prepare strategically rather than merely reacting to events. At an advanced stage of wealth protection, mere diversification is insufficient for safeguarding assets. Macro awareness becomes crucial for effective wealth preservation and growth. This involves closely monitoring broad economic indicators and their potential impacts. Key indicators include shifts in interest rates, which affect borrowing and investment costs. Other vital factors are liquidity tightening and prevailing inflation trends, impacting purchasing power. Understanding asset bubbles is crucial for macro awareness in financial markets. An asset bubble occurs when asset prices rise rapidly, exceeding their intrinsic value. This rapid increase is often driven by speculative buying rather than fundamental value. Recognizing these patterns helps investors avoid participating in speculative excesses. This knowledge protects capital from sudden devaluations when bubbles eventually burst. Market volatility is often perceived as a significant risk factor for investors. However, a deep understanding of capital's rhythm and mechanics changes this perspective. When investors grasp these underlying principles, the fear of market fluctuations diminishes. Volatility is no longer seen as a threat, but rather as a dynamic market condition. Instead, it becomes a source of potential opportunity for strategic investment actions. Strategic patience is a crucial, yet often overlooked, attribute in financial decision-making. It involves a deliberate and prolonged period of disciplined inaction. This approach focuses on waiting for optimal market conditions to emerge. Such patience can lead to significantly higher financial returns over time. Not all perceived opportunities warrant capital deployment. Discerning investors selectively engage with prospects. This principle ensures resources are conserved. Capital is reserved for truly advantageous prospects. Not every market trend warrants attention or exposure from investors. Advanced investors prioritize a select few high-conviction opportunities. This focused approach is more effective than pursuing every market movement. It emphasizes quality over quantity in investment decision-making. Advanced investors prioritize capital preservation as a fundamental principle. They understand that avoiding losses is a form of profit in itself. This strategy emphasizes protecting existing assets from depreciation. Minimizing downside risk is as crucial as pursuing potential gains. Capital preservation is essential for sustainable, long-term wealth accumulation. Liquidity is a fundamental source of power within financial markets. It refers to the ease with which an asset can be converted into cash without affecting its market price. Maintaining sufficient liquid assets provides essential financial flexibility. This capacity allows for decisive action when opportune financial moments arise. Silence, often overlooked, functions as a powerful form of leverage in various contexts. It implies that discrete and calculated actions can yield greater influence than overt declarations. This principle allows for strategic maneuvers to be executed without attracting undue attention. By operating quietly, one can maintain an element of surprise and control the narrative. Public statements can often limit options and create unnecessary opposition. Thus, strategic silence is a valuable tool for maximizing impact and achieving objectives effectively. Capital allocation is a critical process in financial management. At an advanced level, it becomes a highly mathematical and intentional process. This approach ensures that emotional influences are entirely removed from decision-making. Funds are distributed based on rigorous analysis and objective criteria. This prevents impulsive decisions that could jeopardize financial stability or growth. The model prioritizes strategic deployment of capital for optimal returns and risk management. Capital allocation involves strategically distributing financial resources across various categories. A key component is designating cash reserves specifically for asymmetric opportunities. These reserves enable organizations to act swiftly when unique, high-potential situations emerge. This proactive approach maximizes returns from unforeseen market advantages or strategic investments. Capital allocation strategies include various asset types to optimize portfolio performance. A key component involves stable income-generating assets within the allocation model. These assets are specifically chosen for their ability to provide a consistent return stream. Their inclusion significantly contributes to the overall stability of the investment portfolio. Furthermore, these assets ensure a predictable and reliable flow of cash over time. Capital allocation strategies are crucial for wealth management and financial growth. A key component of these strategies involves long-term compounding vehicles. These vehicles are specifically designed to generate exponential wealth growth over extended periods. The primary mechanism for this sustained growth is the principle of compound interest. Compound interest allows returns to be reinvested, generating further returns on the accumulated sum. This approach ensures that capital grows not just linearly, but at an accelerating rate over time. The capital allocation model includes strategic, high-upside positions. These positions target significant returns from carefully selected ventures. Such ventures inherently carry a higher degree of risk. The primary goal is controlled acceleration of growth. This strategy avoids mere excitement or speculative gains, focusing on calculated expansion. Risk is not an entity to be simply avoided or passively accepted in strategic planning. Instead, it is a dynamic element that requires proactive and meticulous engineering. This approach involves the deliberate design of exposure to potential risks. It shifts from a reactive stance to an active, anticipatory management strategy. The goal is to transform risk from an unpredictable threat into a controllable variable. Through engineering, risks become manageable factors within a defined operational framework. Risk engineering shifts focus from maximizing gains to minimizing potential losses. The primary question evolves from "how much can I make?" to "how much can I lose?" This approach prioritizes the identification and control of downside risks. By effectively managing potential negative outcomes, stability is enhanced. Controlling downside risk makes potential for upside more scalable. This strategy leads to more predictable and sustainable growth. In high-stakes financial environments, emotional detachment is a crucial asset. This detachment allows investors to remain objective amidst market fluctuations. It prevents decision-making from being swayed by exaggerated news cycles. Emotional detachment also guards against irrational responses to market overreactions. Maintaining objectivity is key for sound financial judgment and strategy execution. This principle is vital for consistent, rational decision-making in volatile markets. Capital multiplication occurs through strategic positioning within influential networks. This positioning grants access to exclusive private deals and early-stage investment opportunities. It also facilitates the formation of crucial strategic partnerships. Reputation combined with capital unlocks opportunities beyond conventional public markets. True financial freedom is fundamentally defined by optionality. This optionality grants individuals significant control over their time. It enables the ability to exit undesirable situations without financial constraint. Financial freedom also allows for taking calculated risks without undue pressure. Decisions can be made based on strategic timing rather than immediate financial necessity. Ultimately, it provides the liberty to align choices with personal values and goals.